Today, we're going to start our session with a conversation with my dear friend, Gus Tai, whom you've seen here many times because Gus and I are, sounding boards for each other on many topics. And every year we do a few of those sounding board sessions in public at these roundtables. So we kind of talk about the topics that we want to kick around with you guys so that you guys can also, be part of that kind of brainstorming. And that's what we're going to do today. The last few years, it's been at the end of the year that we do kind of like a recap and exchanging notes on the year. Gus, welcome back. It's great to have you. And I'm sorry we have a bit of technical issues this time.
Oh, so wonderful to see you, Shamana, and no worries at all about these technical complications.
So we're going to start with a hairy, controversial topic. And my conclusion is that the venture capital industry is way too big. There are too many firms and it's causing problems. Let me frame this conversation segment for all of you so that you can follow along. We've had a hyperactive venture capital industry since the mid-90s, when the internet first came into being as an engine of innovation. In 30 years, the industry has accumulated enough data to show that the vast majority of VC-funded startups fail. Absorb that. Some fail altogether. Some succeed in building customers, revenues, profits, but are slow growth. They're not growing exponentially. They're not going from $0 to $100 million in 5 to 7 years. And their exit prospects are not in line with the amount of capital that they have raised. So what happens? They become zombies. And yet, entrepreneurs still believe entrepreneurship equals financing. They mindlessly chase venture capital and raise money without a clear idea of how they plan to build a high-velocity, hyper-growth, exponentially growing company. And in our industry, dumb money abounds. I would say the vast majority of venture capitalists do not understand venture capital. They don't know what they're doing. So they set hundreds of thousands of entrepreneurs up for failure by investing in them. But if you take venture money, you have to grow at venture pace, which is $0 to $100 million in 5 to 7 years. So this is a problem. This dynamic is a real problem in the industry. And what I want to start with today with Gus is to kick around this particular issue and brainstorm about how to change that. Gus.
Oh, for sure, Shamana. And there were a couple slides. I don't know if you were going to cover those now or cover them later regarding the cyclicality of venture.
Maureen, could you move to the next slide? Yes. So Gus sent along a couple of very interesting slides with some data. So it is actually true that the number of active VCs has dropped since 2021, which was the peak of the industry. Gus, how do you read this slide and what color do you want to provide to this?
Yeah, for sure. And so I guess for context, I think it's important to remember or to observe that venture capital is a cyclical industry, and that there are times when there's too much capital, relatively speaking, and there's times when there's not enough capital. I would say that leading up to COVID, there was too much capital. And this slide that you can see highlights that from the great financial crisis until COVID, there was an increasing amount of dollars flowing into venture capital, which allowed an increasing number of venture firms to be created. So going back 10 years, according to PitchBook, in 2014, there were about 3,000 active venture firms, which means, and this is probably North America, which means that they would make at least one investment a year to define active, and many would make many more. That number almost tripled from 2014 until 2021, at which time there's about 8,200, 300. That meant that during that period of time, there's 3 times as many firms making a large number of investments. And going back to some of the themes Sharmana is highlighting is how skillful were these venture firms at helping the venture companies that they're funding during this period of time. And then since COVID, the number of active companies has dropped by 1,000 firms a year, more or less, and that they're perhaps not being able to raise additional funding. Perhaps they're looking to stop being in the venture business. But it highlights that there was an excess supply of venture firms relative to dollars and relative to startups out there. And so this is highlighting the cyclicality that in boom times, things really go boom, at which time folks may not be as skillful as you would like. And
well,
we're going in the direction.
One of the interesting points is the peak of this is 2021, which is the peak of COVID. So not exactly boom time in the, not traditional sense of the word, but somehow or the other, the venture industry peaks in 2021, 2022, which is the height of COVID. You have.
And the next slide, Sharmana, I would also want to comment, and then we could go into the broader discussion.
You have the next slide, Maureen.
Yeah, Maureen, if you could move to the next slide, which has the amount of this chart is a complement to the prior chart. But the reason I wanted to highlight this one, this is also coming from PitchBook, is that if you look at this is the amount of dollars that are being raised by venture firms, and it actually peaked in 2022. So the prior slide was around the number of investments, number of venture firms who are active in making investments. This is the venture firm raising money. So the peak amount was in 2022, and it's plummeted from 2022 to 23, 24, 25. Note that 2025 is for 3/4 of the year, not the whole year. But in 2024, that large bar of which I would say $80 billion has been raised, in that year, which is our most recent complete year, if you think about the Pareto of how many dollars went to funds, normal Pareto, you'll hear about 80% is done by 20% of the participants, or 80% of the outcome is result of 20% of the work. In venture in 2024, 75% of the dollars went to 30 firms. That's a 75%. The Pareto here is 75-4. 75% of the dollars went to 4% of the funds raising money. And you would say 30 firms, these firms, if they're raising annually, on the prior slide, there's 6,000 active firms. So 30 firms are collecting the bulk of the money. Venture is fundamentally different today than it was 10 years ago. And so the themes that Sharmana is highlighting apply to many of the venture participants, but I would say that one major difference is there's this institutionalization of very, very large firms that have a lot of assets under management providing different types of services.
Which changes the nature of venture capital. We have seen in the last few years, especially 2023, if you see this chart, 2023 is kind of the point at which generative AI, the mania starts, really. ChatGPT hit the market in 2022, but the mania hit the market in 2023. And at this point, these mega investments in some of the very large LLM companies and, like Anthropic and OpenAI and Mira Murthy's company, Thinking Machine Labs, which with no product, nothing, is valued at billions and billions of dollars. So that phenomenon of what we call the hyperscalers kicks in high gear, and the fundraising is showing that behavior, right?
Yeah, well, it's showing it's showing this barbell effect that we're hearing about mega rounds of companies at mega high valuations. And those are predominantly being funded by these top 30, 50 venture firms that have large pools of assets under management. It's a different type of business compared to having $500,000 or $1 million or a couple $1 million allocated to a bootstrap team or to a team of 5 people.
Yeah. And those large 30 funds are not playing that game anymore. They're not really investing in these little companies that are going to grow in a more disciplined way. They are really going for a very different kind of venture capital, which is basically very fat startups that start off with huge amounts of capital. And that kind of capital is, it turns out to be one of the moats, because very few people can raise that level of capital. And so a few startups basically dominate that part of the market.
Exactly. And even in this time of big funding rounds, it's probably harder to raise money if you don't have a company that fits into that model.
Which comes into another part of this discussion. We are, just as this thing is happening of these very, very, lavishly funded companies, there is another phenomenon that is running parallel to it, and that has really hit high gear this year, which is, this is also the golden age of bootstrap startups. People are getting a lot more done a lot faster with a lot less resources, a lot less capital this year than ever before. So we are seeing trends like ultralight startups, solo entrepreneurship, bootstrapped entrepreneurship really kick in high gear. And there comes a different question, which is, once you start hitting that kind of, really nice growth as a bootstrap startup, let me give you the example of Lovable. Lovable, I think probably all of you have read about Lovable, which is an incredibly fast-growing, no-code software development platform, app development platform that is really going gangbusters this year. They went from $0 to $200 million, I think, bootstrapped, and then they raised a lot of money at a very high valuation. And I looked at that and I kind of had the impression that this may not work as well as a venture-funded company. And the reason being, in these no-code companies, no-code platforms, there's a tremendous amount of experimentation going on. It costs like $20, $30 a month. People subscribe, people start writing some apps and then tinkering around with those apps. It's not necessarily the case that this revenue, let's say you have 200 million revenue, it may not be 200 million ARR, or whatever, 50 million, whatever level you're operating at. Just 50 million revenue may not mean 50 million ARR, because you don't really know what kind of churn you're going to experience, what is the stickiness of the customer base. So churn tends to be high in these. What I'm hearing from everybody is that churn is very high in many of these companies. So if you raise money, a lot of money, without figuring out what your actual churn rate is going to be, then you're not going to be able to sustain the growth. So Gus, let me turn this back to you to comment on how does that scenario play into the venture dynamics?
Yeah, no, Sharmana, I think you're highlighting perhaps the most important question an entrepreneur should have, and that is, what really are the specific needs the customer has that I could deliver in a way that's economic and delights the customer? And if the customer is only temporally interested in novelty or curiosity or testing, that's all well and good. But if you build a company assuming that novelty and curious behavior becomes sustainable, then that creates a complication. So venture dollars can be helpful if you know your model works, because you're super close to the customer and you're looking to scale what works. I think that in the period we're in, I would just highlight that to be cautious about confusing novelty for real enduring value creation for the customer. And the beauty is that it's a lot cheaper to do testing. So I like the model of staying lean and refining the model before scaling.
So I have another actually very contrarian perspective on this topic, Gus, which I want to share with you and hear what you have to say. VCs have to build companies, or VCs have to help build companies. So the value creation for VCs is not in the cash that's being generated. It is in the valuation of the company at which it's eventually going to go public or get acquired. It's the company has to become, sustainable and exitable. The main thing is exitable. After that, what happens is not the concern of the VCs, but it has to be exitable. And up to the point that it exits, it has to be growing at a fast pace. Otherwise, it's not going to find a good exit. The entrepreneur, especially the bootstrapped entrepreneur's perspective, is slightly different. For the bootstrapped entrepreneur, cash is king. So let's say you get into the market and, okay, people are testing your software and you suddenly see a hockey stick in revenue and you have cash flowing in. That is a great situation because that gives you ammunition with which for you to experiment. My take is that cash is really helpful for you to figure out what you want to do with it. The platform on which we are doing today's session here is Zoho. We just switched from WebEx to Zoho. And we've been using Zoho in other parts of our organization, and we wanted to integrate with those. That's why we brought Zoho into this, the roundtables. This is a company that started as a little network management software company. And it was little. But it was a cash cow little. It was a little cash cow. It was generating maybe $5 million a year, not growing fast, but it was generating, very profitable cash. And Sridhar Vembu, the founder CEO of Zoho, used that cash to experiment with the CRM software that was a competitor to Salesforce.com. And this was the mid-2000s. And that product was offered to the market at 1/6 of the price of Salesforce.com. And that got Zoho into the market explosively. And it turns out that their revenue for Zoho was enduring revenue, and they have layered product after product on top of that portfolio. And they have probably 20, 30 products in that portfolio, all very affordable, going after the small business really. And it has become a very large $1 billion plus bootstrapped enduring business. But remember what I said, there was a cash business in the very beginning that gave them the seed capital with which to do all this experimentation. So for those of you who are building bootstrapped businesses at the moment, taking advantage of this golden age of ultralight startups, experimentation, bootstrapping, LLM wrappers. LLM wrappers are everywhere right now. We're doing all kinds of things with LLM wrappers, and those are great, tools with which to experiment and build fast growth businesses quickly. May not be enduring revenue, but it could be cash with which you can do other things. So there is the venture perspective for whom churn is a huge problem, and you should not raise venture money without establishing that your business is an enduring business. But if you are doing experimentation and some product is hitting the chord with some segment of customers and throwing in a lot of cash for you, by all means, keep collecting that cash, because that cash is going to give you lots of optionality. Yeah?
Yeah, Shraman, I was taking and appreciate the perspective, because it made me realize that so venture capital is a financial resource, and it's really helpful for the case where you want to scale quickly for whatever reason. But it's a type of finance where in short, venture capitalists buy low, sell high. That's the driver of the business as it's a finance business. So you as an entrepreneur, if the resource is helpful for you, you could purchase it by selling your shares and use that resource. The dilemma, I think, today, or the opportunity today, is that I would say, whereas in the 90s, or in the early 90s, the entrepreneurs bootstrapping a business was more expensive, and venture capitalists didn't have as many opportunities for what they wanted to deploy their capital against. They would actually fund venture. They would actually take on risk of formation of a company of people with some ideas and do that. And there's high infant mortality, but high upside from that. Fast forward to today, the vast majority of venture dollars are going to different types of companies, in particular these AI large capital intensive businesses where capital is the moat. And it may not be as suitable for these large venture firms to do the venture capital of very small companies. And at the same time, it's a lot cheaper to bootstrap a company. So I would just say that why not bootstrap a company and pay attention to how your rate of learning and how you want to apply that learning. And venture, when you get to a certain scale, will be available if you're showing that revenue growth rate against something enduring. But to look and spend a lot of time to raise venture capital early on, it's probably more difficult, especially when it's so much cheaper for you to do your own experimentation.
So Gus, that is a very good segue into the other class of venture capital companies that are in the market. Those 30 funds that are raising mega capital and doing these mega deals, let's take them out of the loop. But there are many other companies, and actually there's a very large seed capital, pre-seed capital, post-seed capital kind of focus venture funds out there. And a lot of the problems that I talked about at the opening of this session, which is, people are investing things that should not be invested in and setting entrepreneurs up for failure. Those are the culprits of that behavior, right? They invest in things, and many of these VC funds don't have the quality of deal flow that is venture worthy, but they have to invest. Otherwise, they haven't been given capital by their limited partners. Some of these are very small funds, but if they don't have deal flow, they still invest because they have to show to their investors, limited partners, that yes, they are investing. And a lot of companies which should never have raised venture capital are going and raising venture capital. And that is a real shame, because some of those companies as bootstrap businesses would have succeeded in building sustainable companies. Instead, they become zombies.
Yeah. So I guess the way I view that is that there's a marketplace where venture is a resource. And I would say that in the 90s and the noughts, there was a lot less understanding of what it meant to take on new stakeholders. So when you raise venture capital, you're bringing on new stakeholders who have interests that are aligned with yours, but also interests that are different. When you have a partnership with anyone, they'll have different views. And I would say that there's a larger gap of misunderstanding decades ago. And I'm hopeful that today, entrepreneurs, through education and through insights such as what you're providing, Sharmana, are going to be more informed about what it means to take on a venture capitalist as a partner. So I would not characterize the venture industry as causing startups to fail. I would just say partnering with venture capitalists could make your goals more complicated. And if you have a viable bootstrap business, it will be different if you raise venture capital, and just realize that. And so are you informed about taking on this resource and taking on these partners?
I wish I could say to you, Gus, that we are succeeding in educating the market better and away from this entrepreneurship equals financing point of view, but we're not. in these sessions, I'm constantly encountering entrepreneurs who should not raise money, who should not even think about raising money. They're all chasing venture capital mindlessly. And the buzz around capital raising is so dominant in the startup industry that entrepreneurs with not much understanding of what the hell they're doing come into this business, come into the startup business. They decide they're going to do a startup, and they immediately think, oh, now I need to go out and raise money. This is actually the dominant theme, dominant thought process of startups. Unfortunately, we have no way of countering it so far. Yes, 1Mby1M has been one of the loudest voices countering this problem. And we have gotten some distance. We have built a lot of successful bootstrap companies and encouraged a lot of successful bootstrap companies. But I think we are really swimming against the current, and it's not easy to swim against a current that is that powerful around the world. So that's, I would say that is a disappointing conclusion that we have come to after doing this for 20 years, actually. So I've been countering this current for 20 years, and it has not been an easy thing to accomplish. We have had some.
I think, Sumana, so what you were highlighting is, to me, the way I receive that, and it makes sense to me, is the nature of the human nature is of a certain type of property, and without experience, then that would be the tendency. I am curious in that I agree with you that we're in this golden age of bootstrapping, a golden age of solo founded companies. And even Carta, which manages a lot of venture-backed companies, highlighted that the number of solo-founded companies registered on Carta has grown 50% as a percentage of companies in the last 5 years. And so, if it's cheaper to do experimentation, perhaps you'll see a shift. But I agree that human nature is what it is, and so there's fighting against the tide, but nonetheless, it's a valuable resource to share this information to cultivate wisdom in people.
So, you said two things there that I want to elaborate on a little bit, and I know we are almost at the end of the time that we had allocated. Human nature is, as you have pointed out many times, is status seeking, and the status until now has been in venture funding your startups. Venture funded startups think they have much higher status than bootstrapped entrepreneurs, and the media treats bootstrap entrepreneurs poorly. Sridhar came to see me in 2007, and in my living room sitting, I remember still vividly that conversation. He said, no media wants to cover because I have not raised venture capital. And I was stunned by what a fantastic story it was. I did the first story on Zoho. I wrote about it. There's an interview on my blog that you can still go and see. And then I wrote the first big story about Sridhar Vembu and Zoho on my Forbes column. And that's how the world found out about Zoho. But it was stunning to me that the media had no understanding of a really high-powered bootstrap entrepreneur and how much potential that company was showing. They just didn't know how to read it. But that is starting to change a little bit. If you go to LinkedIn right now, LinkedIn is full of AI slop, but LinkedIn also has some entrepreneurs bragging about how well they're bootstrapping. And that's a good thing, because that's coming from the horse's mouth. What we have done here is we have done case study after case study of entrepreneurs telling their bootstrap story and bootstrap success story, or bootstrap first, raise money later success story, bootstrapping with a paycheck success story, solo entrepreneur success story, bootstrapping using services success story. All of this is helping generate awareness. And I think I'm thrilled that this Carter report of 50% increase in solo entrepreneurs is happening. We have supported solo entrepreneurs from day one, but these poor solo entrepreneurs have faced so much bias. The accelerators don't want them, the VCs don't want them, everybody wants a co-founder. Well, the truth is, getting along with a co-founder is not so easy. Marriages break, but breaking up your co-founder, divorcing your co-founder is not an option. It sits on your cap table, and you cannot restructure your cap table. You can get divorced, but you cannot restructure your cap table. And, getting along with another human being with no hierarchy at the exact same level, equal co-founder under tremendous amount of stress is very, very difficult to do. So it's, yes, it is lonely to be a solo founder, but it doesn't have to be lonely. You have your team. You build a good team. If you're a good manager, good leader, you can lead a good team and you don't have to be lonely. It's having a co-founder doesn't necessarily mean that you're so, well supported and so forth. So these are, biases that are there, and it's great that performance is going to speak for itself. I think we're going to see a lot of solo founders doing really, really well. We've already seen some very interesting solo founder companies. Base44 was completely solo founded in 6 months, got acquired by Wix for $88 million. We've seen, ServiceNow, which is a mega multi-billion-dollar company, one of the best companies that have come out of the whole SaaS revolution. That was a solo founder. I interviewed him in 1999, Fred Luddy, and he was a little company at the time, and I found him to be amazing, absolutely. So that's a solo founder who built a team and built a fantastic company. So there are tons of solo founders who are doing great. So if you're listening to this as a solo founder, please take it as complete and unambiguous support. We support solo founders, and we will figure out how to help you succeed, and including raising money. As soon as you start showing performance and metrics, you are fundable, solo or not. It doesn't matter. So, Gus, is there anything else? I know we are out of time, but is there anything else you want to add to this discussion on?
Yes, I would want to just say one thing, one major theme I would just call out that would, in my mind, wrap all of these topics together. And that is that the broader theme for the opportunity for entrepreneurs to have an edge today is to really embrace how disruptive AI is and what discontinuities will arise, including how much easier it is to set up a company and experiment and test. So whereas in the late 90s, it was hard to be a solo founder for lots of different reasons, and you needed resources like a lot of cash to run data centers and build out infrastructure. Today, I think that the pressure of AI causing traditional jobs to be redefined makes it incumbent upon all of us to think about ourselves as sole proprietorships. And as we as sole proprietor, SMEs, how do we use AI to augment our team? And then, of course, it's helpful to have other human employees and participants and bring them on board at the right time. But to kickstart, really know who you are, what edges you may have, and augment that and amplify it using AI, and see what might arise. So I think maybe we're at a turning point that 5 years from now, Shimano will be like, yeah, of course you want to be a solo entrepreneur initially, using AI in a bootstrapped way to understand what people really need. Right. So that would be a wholesome way to view the world.
We went through a little bit of this shift in COVID, actually. We, as you know, we have always been a virtual company since 2010, which was very early to be a virtual company. But by 2020, when COVID hit, everybody started becoming virtual companies. So there was no stigma against virtual companies. There was a stigma against virtual companies before. That started going away. Now there is less stigma against virtual companies. I think solo entrepreneurship is going to go through the same kind of transition. And as a matter of fact, AI is there's going to be so many fantastic solo entrepreneur-led AI companies. AI boosted companies, whether it's AI company, mostly it's AI companies. But I mean, in our organization, the amount of productivity we're experiencing because of AI, Gus, is amazing. And of course, we know how to use AI, which is where you need to get to. If you want to be a solo entrepreneur, you absolutely need to get to, training your organization to really be an AI first company. And that's amazingly feasible, amazingly fantastic. So on that note, Gus, thank you. It's a controversial topic. I think what we are saying is, to net it out, we are saying the number of VC firms needs to go down. The number of dollars that are going into venture capital needs to go down. Solo entrepreneurs need to be supported. Bootstrapping needs to be supported. Virtual companies need to be supported. So all these are against the current of the venture capital industry. So, oh, by the way, one more, accelerators. We are a non-equity accelerator. We've been a non-equity accelerator from the beginning. And I believe that accelerators should not charge equity, which is completely contrarian to how this industry operates. Okay. Thank you, guys, for coming. And I will catch up with you soon.
Shramada.
Bye.